Hi, I'm John Peterson. Thanks for watching this video. By the end, you'll understand a little bit more about a topic that can be confusing: bonds. A bond is actually a loan that an investor makes to a corporation, a government, federal agency, or other organization. Since bond issuers know you aren't going to lend your hard-earned money without compensation, the issuer of the bond, the borrower, enters into a legal agreement with the bondholder, that's you, to pay you interest. And of course, the issuer also agrees to repay you the original sum loaned at the bond's maturity date. A bond's term, or years to maturity, is usually set when it's issued. Bond maturities can range from 1 day to 100 years, but the majority of bond maturities range from 1 to 30 years. Typically, the borrower fulfills its debt obligation when the bond reaches its maturity date. At that time, the final interest payment and the original sum you loaned, the principal, are repaid to you. By installing a trapdoor clause, bond issuers are able to change the maturity date of the bond if it's of benefit to them. In this case, the bond is known as callable. This trapdoor allows the issuer to retire a bond before it matures if interest rates are in favor of the bond issuer. Callable bonds clearly benefit the original issuer of the bond. As an example, if interest rates go down, the issuer may call your bond. If interest rates are higher, the issuer may keep the bond maturity as it is. The amount of interest you earn by owning a bond would be determined by when you bought the bond. As an example, if you bought a new issue bond paying 5% interest, you would earn that 5% as long as you owned the bond or until maturity. But if you bought the bond in a secondary market, you would earn higher or lower interest rates depending on how much you paid for the bond. If you paid less than face value, you bought it at a discount, and your actual interest earned would be higher than 5%. If you paid more than face value, you would have paid a premium, and your actual interest earned would have been less than the face value interest. Consider this rule: bond price and yield are inversely related. As the price of a bond goes up, its value, if sold prior to maturity, goes down, and vice versa. Here are some important terms to know when you consider owning bonds. Yield to maturity, or YTM, is the overall interest rate earned by an investor who buys a bond at the market price and holds it until maturity. Yield to call, YTC, is figured the same way as YTM, except instead of plugging in the number of months until a bond matures, you use a call date and the bond's call price. This calculation takes into account the impact on a bond's yield if it's called prior to maturity. Yield reflecting broker compensation is the yield adjusted by the amount of markup or commission when you purchase, or markdown or commission when you sell, and other fees and charges that you're charged by your broker for his or her services. Remember the cardinal rule of bonds: when general interest rates rise, the value of bonds decreases, and when general interest rates fall, the value of existing bonds increases. Interest rate risk is the risk that changes in interest rates in the U.S. or the world may increase or decrease the market value of the bonds you hold. Interest rate risk, also referred to as market risk, can increase the longer you hold a bond. In addition to market risks, there are also call risks and failure risks. Bonds themselves can fail too. One example would be if the bond issuer fails and can't make interest payments or repay the bond at the end of maturity. Either way, it's smart to know the financial strength of the bond you have loaned money to. Bonds will offer a rating based on their safety. For example, a AAA rating means that the issuer holds the highest credit rating available. Lesser ratings, such as B and C, can still be solid investments. Plus, they'll pay a higher interest rate than AAA. If a bond issuer begins to fail, the ratings can be changed as the credit rating drops. Bonds with a D or F rating may not be good investments for anyone other than speculators. Always ask for the bond rating and make sure you know its ability to meet its financial obligations. There are numerous types of bonds in which to invest. The difference between them lies in the safety rating and the interest offered. A good rule of thumb to follow is the higher rated bonds will offer the lowest interest rates. And the opposite is also true. If you want a higher interest rate, you may have to accept a lower rated bond, and with that, a higher level of risk. Some classes of bonds available include U.S. Treasuries, municipal bonds, corporate bonds, U.S. savings bonds, mortgage-backed securities, and international bonds. You can find out more about bonds and other safe money strategies by requesting a copy of our Safe Money Guide and Best Annuity Rates Report.